Happy Friday to you. We just saw.
Thank you.
Good morning. We just saw the producer price index come in line with expectations for the most part. It does look like a slight improvement there, or a slight uptick, I should say, in terms of the year-over-year numbers for the core. As you can see, they came in at 2.5%, a little bit below expectations, but above the prior reading of 2.0%. I do want to point out the PPI year-over-year also increasing slightly to 2.8%, up from that 1.7. Larry, is this something to take note of here, or is this just kind of in line with the trend that we've been seeing as far as muted inflation?
Yeah, well, looking at the way the market has judged past numbers, especially looking at CPI over the past 3 months, actually, it just appears to me that it's something to pay attention to, but I do not think it's going to change the current dynamic that we're in right now with regards to interest rates, the dollar, the equity market, et cetera.
Larry, let's talk a little bit about the inflation component here, because we just got this $2 trillion stimulus package. We've got crude oil prices, grains. We're talking commodities in general, asset prices, which have been inflated. I mean, one could argue it's just a matter of time. It does appear as if the Fed, at least at this point, doesn't be too concerned. But I'd imagine coming next week, this is going to be something to dial in terms of what we're listening for as far as Fed Chair Jerome Powell. We're going to still want to get a feel for where they stand, where that inflation gauge is on their radar.
Yeah, and it's mind-boggling to me when I look at like corn prices and soybean prices, and corn's trading at $5. I can't remember the last time that happened. But all that to say, there's this dynamic in place in the market, like a divergence, and so it's reducing the angst of the Fed as far as I'm concerned. You see break-evens rallying, and that's offsetting the decline in real yields. And keeping with that dynamic, you have the S&P hitting new highs. And so I think that's reducing the angst going into the meeting next week. However, the bigger picture is like, what type of inflation are we going to see? Is it really cost push through inflation with that comes as a result of higher wages? I doubt it, with the amount of people still out of work. So I think the market might be getting ahead of itself, but the markets always do, as we know.
Yeah, tough environment to get a raise in right now, to say the least. Let's talk a little bit about some of these commodities that have been on the rise. You mentioned corn. It's not just corn, wheat, and beans for that matter. We saw the WASI report this week, but I wanted to get your thoughts on commodities, or I'm sorry, energy markets first and foremost, because one thing that I noticed is the RBOB gasoline futures on the move higher. I keep hearing about schools reopening and economies getting back to normal. I'd imagine this is a major focal point to keep an eye on in terms of a real hard indicator of that, or lack thereof.
Yeah, and when you see crude at $65, $66, it's worth noting. And you see gasoline at the highs it's hit. We have crack spreads at a 10.5-month high, which just further incentivizes the market to do what it's doing. What's amazing about the energy market as a whole, at least this past week, is that it continues to climb this wall of worries. And we see that happen all the time. But there's so many negatives out there with regards to either OPEC's statement, OPEC's commitment. You have Libya with increasing production. Floating storage is again at a high, and last week's EIA report had crude at above the 6-year average in terms of inventory. But that said, it continues to climb, and so I think the market's just being pushed to that equilibrium where eventually it might back off. But I don't see that happening anytime soon.
Yeah, great point in terms of bringing up some of the fundamentals, what's behind the bid in crude. And, one thing that I took note of this week was even amidst a dollar, which for the most part has been holding bid levels, the strength that we've seen in crude, oftentimes you see that inverse correlation, the dollar.
Right.
When you don't see that, it really speaks to the focus being on those fundamentals and some of the other catalysts here. Let's talk a little bit about what we've been seeing as far as gold. It's continuing to come off. Well, it's lost some of the momentum to the downside, but certainly really taking a hit here off that 2100 level we saw last August. I kind of tied it to the yen this week in terms of that real safe haven type tendency coming out of the market, those products that we often see as, well, you see volatility in the indices, or maybe it was, I've been kind of chalking it up to some of the fear unknowns, election results, vaccine, coronavirus uncertainties starting to diminish a little bit. I mean, certainly we've been watching gold come off, and even with the dollar, which again, for the most part, hasn't really seen too much momentum to the upside. It's firmed a little bit, but still fairly range bound.
Yeah, and the fascinating thing about gold, in my mind, is that sometimes it's a commodity, sometimes it's a currency, sometimes it's a safe haven. And I think it's just trying to figure out what it is right now. But I think it's tending to act as a offset to interest rates, and at least that's my take on it. And like I said last week, I just would not touch gold right now. I still would wait. Without being a technician, I would wait to see it down in the low 1600s before I became interested in it, because I do think we're still trying to find equilibrium with treasury yields. And with that in mind, I just don't see a case for gold without some other event happening, because right now it definitely is not a safe haven mechanism. It's more of an interest rate one.
Yeah, let's talk a little bit about, as mentioned a minute ago, in terms of the focus being on gasoline futures, energy products in general, a reflection of economies getting back to normal. Can we talk a little bit about how copper and silver have done a little bit better relative to some of the downside price decay we've seen as far as gold, as we've lost momentum to the upside there? But copper, although it has lost some of the momentum around a key resistance area, 240, 250, it's slowing some. For the most part, no rejection of these upper levels. Silver holding or faring a lot better than gold for the most part in terms of some of the price decay. I mean, this really speaks to the industrial aspect of things, and then ultimately the focus being on economies, stimulus. And I'm already starting to hear about this BBB plan, this infrastructure plan that President Biden's starting to, we're going to hear about apparently next week. Can you talk to what we should be watching here as far as industrial metals in terms of, and kind of tying it back to how we're focused on energy products, getting a better indication or at least a little bit more information in terms of economies and them bettering?
Yeah, well, I think, if you look at copper, at least identifying that by itself, you really need to look at the broad base of industrial metals, looking at iron ore, zinc, et cetera, because I think they're all together, as it were, with regards to its trend. Now, copper was the first one to rear its head. Actually, iron ore was. Copper was second. And a lot of the initial move was with regards to storage and warehouses, using it as a financing tool in China, and the fact that China's growth prospects seem to be much, much quicker than ours right now. And then from this point on, it seems to be acting more as a bellwether to what's going to happen here with the economy in the United States and around the world. And it is at a lofty price. I mean, $4 copper is like, I don't remember when I've seen that. But that said, we have a lot of pent-up demand, a lot of infrastructure projects that aren't going to be a one-year thing. I think that's something that's going to be incorporated into our society for the long term. Because I just don't think the private sector has the ability to multiply capital. So we're going to require the public sector to do that, and infrastructure is one way to achieve that.